Let me paint you a picture. It is a Tuesday morning. Two people wake up at the same time in the same city making almost the same income. One of them started making smart financial moves in their 30s. The other one did not. Fast forward 25 years, and their lives look absolutely nothing alike. One is traveling, stress-free, watching their money work for them. The other is still working, still stressed, still wondering where all the money went. The difference between those two people is not luck. It is not an inheritance. It is not even a higher salary. It is one decision made at the right time. Welcome back. This is Ron Invest. If you are new here, this channel is all about helping you take control of your financial future with real, practical strategies you can actually use. If this is your first time watching, make sure you hit that like button and subscribe right now, because the content we put out on this channel could genuinely change how you think about money forever. Now, let us get into it, because today we are talking about something that applies to millions of people right now. What does your life actually look like if you start building wealth in your 30s? And the answer might surprise you. Let us start with the truth that nobody really tells you when you are young. Your 30s are not too late. In fact, for most people, your 30s might be the perfect time. Here is why. In your 20s, you are figuring things out. You are changing jobs, moving cities, making mistakes, spending money on things that do not matter. That is normal. That is growth. But by the time you hit your 30s, something shifts. You start to get serious. You have a clearer picture of what you want. And if you channel that energy into your finances, right now in your 30s, the compounding effect of time is still massively on your side. Let us talk numbers first, because numbers tell the truth better than anything else. If you invest just $500 a month starting at age 30 with an average annual return of 8%, which is historically very reasonable based on broad stock market performance, by the time you reach age 65, you will have accumulated approximately $1.1 million. $1.1 million from $500 a month. That is the power of compounding. That is what starting in your 30s can do for you. Now, if you wait until your 40s to start that same habit, the number drops to around $370,000. That is still meaningful, but it is a $730,000 difference just for waiting 10 years. 10 years of hesitation, 10 years of saying, I will start next month, costs you nearly $750,000 in retirement wealth. That is the real cost of delay. So what does your life actually look like when you make the decision to start now? Let us walk through it, year by year, decade by decade, and see exactly how this plays out. The first year, when everything changes. The first year is the hardest, not because the actions are complicated, but because habits are hard to build. When you start building wealth in your 30s, the first thing that changes is your mindset. You stop seeing money as something to spend and start seeing it as something to deploy. That mental shift is worth more than any financial tip I can give you. In the first year, the most important moves are simple. You build an emergency fund. You get out of high-interest debt. You start contributing to a retirement account, whether that is a 401k, an IRA, a Roth IRA, or whatever is available in your country. And you start tracking your spending for the very first time. None of this is glamorous. None of this is going to make you feel rich right away. But this is the foundation. And without a strong foundation, everything else collapses. The person who builds this foundation in their 30s is already ahead of the majority. Studies consistently show that a large portion of people reach retirement age with less than $50,000 in savings. That is not a retirement. That is a crisis. By simply starting, by simply taking these first steps, you are separating yourself from a very large group of people who will regret not doing this earlier. Your finances in your late 30s. Now let us say you have been at this for a few years. You are in your mid to late 30s. What does life look like now? You have an emergency fund of 3 to 6 months of expenses sitting in a high-yield savings account. You are no longer stressed about a car repair or a medical bill wrecking your budget because you have a cushion. That alone changes the quality of your daily life in ways that are hard to fully describe until you experience it. Your retirement accounts are growing. Maybe you have $30,000, $40,000, maybe even $70,000 invested at this point, depending on how aggressively you started. And here is the beautiful thing, that money is compounding quietly in the background while you live your life. You are not checking it every day. You are not panicking about market dips. You have a long-term strategy and you are sticking to it. You have also likely started to educate yourself about investing more broadly. Maybe you opened a brokerage account. Maybe you started learning about index funds, ETFs, dividend investing, or real estate. Your 30s are the years where your financial education accelerates because now you have skin in the game. Now it is real. One of the biggest advantages of starting in your 30s is that you still have time to make mistakes and recover. You can try a strategy, learn that it does not work for you, adjust, and keep going, all without losing decades of compounding time. Someone who starts in their 50s does not have that luxury. Every mistake costs them more. But you, starting now, have the gift of time and the wisdom of experience. The psychology of wealth building in your 30s. Let us talk about something that does not get discussed enough. The psychological transformation that happens when you start taking your finances seriously. When you do not have financial clarity, money becomes a source of anxiety. You avoid looking at your bank account. You feel guilty when you spend. You feel worse when you do not spend, but you still do not seem to be getting ahead. There is this low-level financial dread that follows you around everywhere, on vacations, at family dinners, even when you are trying to sleep. But when you build a plan, when you know your net worth is going up, when you can see your investment accounts growing, when you know your emergency fund is there, something incredible happens. The anxiety starts to lift. You stop making fear-based financial decisions. You start making strategic ones. This is one of the most underrated benefits of starting to build wealth in your 30s. Not just the money itself, but the peace of mind that comes with it, the confidence, the feeling that you are building something, that your future self is going to thank you, that you are not just surviving, you are actually winning. And here is what is really interesting. That confidence bleeds into every other area of your life. You become more confident at work, because you are not desperately clinging to a job out of financial fear. You take more intelligent risks in your career. You negotiate better. You say no to things that do not serve you. Financial security creates personal freedom, and that freedom changes everything. What your 40s look like when you started in your 30s. Now this is where things start to get really exciting. Let us jump forward. You started investing at 32. You have been consistent. You have had good years and bad years in the market, but you stayed the course. Now you are 42. What does your life look like? Your retirement accounts likely have somewhere between $150,000 and $400,000, depending on your income level, contribution rate, and market performance. Your net worth is climbing. You may have paid down a significant chunk of your mortgage if you own a home. You are no longer living paycheck to paycheck, not even close. More importantly, you now have options. And options are the real currency of wealth. Maybe you realize at 42 that you want to switch careers. You want to start a business. You want to go part-time so you can be more present with your kids. Because you started building wealth in your 30s, you can actually do that. You have a financial buffer that gives you the ability to take calculated risks that most people your age simply cannot afford to take. This is what people mean when they talk about FU money. It does not mean you are extravagantly rich. It means you have enough saved and invested that you have real leverage in your life. You can afford to walk away from a toxic workplace. You can afford to wait for the right opportunity. You can afford to say no. That is power. And it starts with the decisions you make in your 30s. By your mid-40s, you may also be exploring additional income streams. Real estate is a popular one. Many people who started investing in their 30s find themselves with enough capital by their 40s to put a down payment on a rental property. That rental income, over time, becomes another pillar of their financial life, another stream that flows whether they are working or not. The concept of financial independence and how your 30s set the stage. Let us talk about financial independence, because this is the goal behind the goal. Financial independence does not necessarily mean you never work again. It means you work because you want to, not because you have to. It means your investments generate enough passive income to cover your living expenses. This is a very real, very achievable goal for people who start building wealth in their 30s. There is an entire movement built around this idea, sometimes called FIRE, which stands for Financial Independence, Retire Early. Now, you do not have to pursue the extreme version of FIRE to benefit from the mindset. even a moderate version of financial independence, where your investments cover 50 or 60% of your expenses by your mid-50s, completely changes what life looks like for you. When you start in your 30s, financial independence by your mid-50s is not a fantasy. It is a math problem. And math, unlike luck, is something you can control. The formula is straightforward. Spend less than you earn. Invest the difference consistently. Let compounding do the heavy lifting. Do not panic during market downturns. Stay the course for decades. That is it. It sounds simple because the core of it is simple. The hard part is the discipline. The hard part is doing it when life gets complicated. When you have kids, when you have medical bills, when your car breaks down, when the market drops 30%, and everyone on social media is screaming that the world is ending. The people who win financially are not the ones with the best stock picks. They are the ones with the most discipline and the longest time horizon. And if you are in your 30s right now, you still have a very, very long time horizon. What happens if you invest in yourself too? Here is something that pure investment-focused content sometimes misses. Building wealth in your 30s is not just about stock market returns. It is also about investing in yourself, in your skills, your career capital, your health, and your relationships. Your earning potential is one of your greatest financial assets. A 30-year-old who invests in a certification, a skill upgrade, or a side business that eventually generates an extra $20,000 a year, that person is making a financial move just as powerful as increasing their investment contributions. Think about it this way. If you increase your income by $1,000 a month and invest all of that increase, the compounding impact over 30 years is enormous. So do not just think about cutting expenses and investing the savings. Think about growing the top line too. Think about what skills the market rewards. Think about what value you can create. Your health is also a financial investment. This sounds counterintuitive, but hear me out. Healthcare costs in your 60s, 70s, and 80s are one of the biggest threats to retirement savings. People who take care of their health in their 30s, who exercise, eat reasonably well, manage stress, statistically have lower healthcare expenses later in life. They also have more energy to work, to build, to pursue opportunities. Investing in your health in your 30s is quite literally investing in your financial future. The real enemy: lifestyle inflation. Now let us talk about the trap that gets so many people in their 30s, even the ones who know better. Lifestyle inflation, also known as lifestyle creep. Here is how it works. You get a raise. Instead of investing the extra money, you upgrade your car. Then you move into a bigger apartment. Then you start eating out more, taking nicer vacations, buying better clothes. And suddenly, despite making more money than ever before, you are saving no more than you were before the raise. Sometimes even less. This is one of the most insidious financial traps in existence because it does not feel like a mistake. It feels like success. It feels like you have earned the right to enjoy your money. And to some extent, you have. There is nothing wrong with enjoying the fruits of your hard work. The problem is when your lifestyle expands in exact proportion to your income every single time, leaving nothing behind to build with. The people who build serious wealth in their 30s are not the ones making the most money. They are the ones who consciously choose to let their lifestyle grow more slowly than their income. When they get a 10% raise, they invest 7% of it and let their lifestyle improve by 3%. It is not about deprivation. It is about intentionality. The simplest tool for fighting lifestyle inflation is automating your investments. Before your paycheck ever hits your spending account, a set amount gets automatically moved into your investment account. You never see it, you never miss it, and over time, it accumulates into something extraordinary. Pay yourself first, always. Building multiple pillars of wealth. By the time you reach your late 30s and early 40s, if you have been building intentionally, you should start thinking about multiple pillars of wealth. Not just one account, not just one strategy, multiple streams, multiple vehicles. The first pillar for most people is their retirement accounts, their 401k, IRA, or pension. This is the foundation. The second pillar is a taxable brokerage account where you invest in index funds, ETFs, or individual stocks. This gives you flexibility. You can access these funds without the penalties that come with early retirement account withdrawals. The third pillar could be real estate. A primary home builds equity over time. A rental property generates cash flow. Real estate has tax advantages and tends to act as a hedge against inflation. The fourth pillar is income diversification. A side business, freelance work, royalties, digital products, affiliate income, any source of income that does not entirely depend on your primary job. Even an extra $500 or $1,000 a month from a side income, consistently invested over 20 years, becomes a meaningful part of your wealth. The fifth pillar, and this is one people overlook, is human capital. Your relationships, your reputation, your skills, your network. These are assets that generate opportunities, leads, partnerships, and income in ways that a stock portfolio cannot. The people who truly build wealth in their 30s are not just stacking money. They are building a diversified system that generates and grows wealth from multiple directions simultaneously. The conversation about risk. Let us be honest about something. Building wealth involves risk. Investing involves risk. Real estate involves risk. Even keeping your money in cash involves risk. The risk of inflation eroding its purchasing power. The question is not how to avoid risk. The question is how to manage it intelligently. In your 30s, you have time on your side. That means you can afford to take on more market risk than someone who is 10 years from retirement. A portfolio heavily weighted towards stocks, say 80 or 90% equities, makes sense for most people in their 30s who are investing for the long term. Yes, the value will fluctuate. Yes, there will be years where your portfolio drops significantly. But over 20, 25, 30 years, the stock market has historically rewarded patient, consistent investors. The worst thing you can do during a market downturn is panic and sell. This is where most retail investors lose money, not by picking bad stocks, but by selling good assets at the wrong time, driven by fear. If you understand that market downturns are temporary and corrections are a normal part of the investment cycle, you can stay calm while others panic. And staying calm during a crash is one of the most profitable things an investor can do. Diversification is your shield. Do not put everything into one company, one sector, or one asset class. Spread it across domestic and international stocks, bonds, real estate, and other assets. Diversification does not eliminate risk, but it dramatically reduces the impact of any single bad event on your overall wealth. What your 50s and retirement look like. Let us jump forward again. It is now your early 50s. You started building wealth seriously at 32. 20 years of consistent investing, discipline, and compounding. What does life look like? Your investment portfolio is substantial. Depending on your income and savings rate, you could be looking at anywhere from $500,000 to well over $1 million in invested assets. Your home may be largely paid off. You may have rental income coming in. Your kids, if you have them, are older and less financially dependent. For the first time in your life, work feels genuinely optional. You could retire now, at 52 or 55, with a comfortable lifestyle, drawing from your portfolio using the 4% rule, which suggests you can withdraw 4% of your portfolio annually without depleting it over a 30-year retirement. On a $1 million portfolio, that is $40,000 per year. And that is before any Social Security, pension, rental income, or other sources. More likely, you choose to keep working, but on your terms. You take the job that is most interesting to you, not necessarily the one that pays the most. You negotiate aggressively. You take more time off. You work part-time. You start a passion project that generates income. You give more generously. You travel more. This is the life that is available to the person who started building wealth in their 30s. Not because they were born lucky, not because they had a wealthy family, but because they made a decision, built a habit, and stuck with it across the ups and downs of life. The alternative. And why it matters to really see it. I want to spend a moment on the alternative. Not to be harsh, but because contrast is clarifying. The person who does not start building wealth in their 30s often finds themselves at 55 or 60 in a very different situation. Their retirement savings are minimal. They are entirely dependent on Social Security, which for most people is not enough to maintain their lifestyle. They cannot afford to retire at 65, let alone earlier. They keep working, not out of passion, but out of financial necessity. They experience chronic financial stress that affects their health, their relationships, and their quality of life. And here is the painful part. Many of these people made decent money throughout their working years. They just did not do anything intentional with it. The money came in and the money went out. Lifestyle inflation ate the raises. Debt ate the flexibility. Time ran out before the habit was built. That is not a character flaw. That is a pattern that happens to millions of good, hardworking people because nobody ever taught them this stuff. Schools do not teach it. Parents often did not know it. And the financial system, frankly, profits from your confusion. That is why this channel exists. That is why this conversation matters. Because knowing this and acting on it in your 30s is one of the most powerful things you can do for your future self. The practical roadmap. What to actually do. Okay, let us bring this home with a clear, actionable roadmap for someone who is in their 30s right now and wants to start. First, get crystal clear on where you stand. Calculate your net worth. Add up everything you own. Savings, investments, property, retirement accounts. Then subtract everything you owe. Debts, loans, mortgage balance. That number, positive or negative, is your starting point. You cannot navigate without knowing where you are. Second, build your emergency fund. Before you do anything else with investing, make sure you have 3 to 6 months of essential expenses in a liquid, accessible account. This is your financial shock absorber. Without it, any financial emergency will derail your investment strategy. Third, eliminate high-interest debt. Credit card debt at 20% interest is the enemy of wealth. You cannot outinvest 20% interest. Pay it off aggressively before you do serious investing. Fourth, maximize your retirement contributions. At minimum, contribute enough to get your full employer 401k match. That is free money, and not taking it is one of the biggest financial mistakes you can make. Then, work toward maxing out your IRA or Roth IRA each year. Fifth, invest in low-cost, diversified index funds. You do not need to be a stock-picking genius. The data consistently shows that most actively managed funds underperform simple index funds over the long term. Keep your costs low, stay diversified, and let the market do the work. Sixth, increase your income intentionally. Ask for the raise you deserve. Develop a high-value skill. Start a side income. Every extra dollar you earn and invest in your 30s is worth multiple dollars in retirement. Seventh, review and adjust annually. Your strategy should evolve as your life evolves. Review your investments once a year. Rebalance if needed. Adjust your contribution amounts when your income increases. Stay engaged, not obsessively, but intentionally. And through all of it, stay consistent. The market will go up and down. Life will throw curveballs. Your income will fluctuate. But if you keep investing, keep building, keep showing up, the math will eventually reward you in ways that feel almost unbelievable. So let me bring it all together. Your life, if you start building wealth in your 30s, looks radically different from the life of someone who waits. Not because you have some secret advantage. Not because you are luckier or smarter, but because you chose to use time as a weapon. And time, when it comes to compounding, is the most powerful weapon that exists in personal finance. You get the financial security that lets you sleep at night. You get the freedom to make career choices based on meaning rather than desperation. You get the ability to give generously, to take care of your family, to pursue experiences that matter. You get the retirement that you actually want at the age you want it, and you get the peace of mind that comes from knowing your future is not something that is happening to you. It is something you are building, one intentional decision at a time. The version of you that starts today, even imperfectly, even with small amounts, is in a fundamentally different position than the version of you who waits. Do not wait. Start now. Start messy. Start with whatever you have. But start. If this video gave you something to think about, do me a favor. Hit that like button. Leave a comment below telling me where you are in your wealth building journey. And subscribe if you have not already. We drop new content regularly on this channel, and every video is designed to help you move closer to the financial life you actually want. This is Ron Invest, and I will see you in the next one.